854 ounces. That is the total registered silver, metal marked as deliverable, sitting inside the system that underpins the world's most referenced silver futures contract. At the same time, other parts of the physical market have been flashing urgency, with reports of double-digit premiums paid to secure immediate supply rather than wait. That combination breaks normal expectations, because it suggests the benchmark price can stay orderly while the real-world cost of getting silver on time, in hand, is quietly rising. Because in moments like this, the market doesn't break the way people expect. It doesn't start with a dramatic headline saying silver is gone. It starts with delays. It starts with rationing. It starts with the quiet reappearance of a word most investors ignore until it's too late. Delivery. Not months, not weeks and 48 hours. A market can reveal its true shape. A single inventory report can change sentiment. A sudden surge in premiums can expose a bottleneck. A backlog can spread from one fabricator to another. And then, the strangest part, the screen price can look calm while the physical market behaves like it's in a storm. They said this could never happen in a modern liquid market. They said the futures market would always keep things orderly. They said any shortage would be instantly arbitraged away. But the data keeps showing something else entirely. If you're watching the plumbing instead of the headlines, you can see the stress building before it becomes a story everyone recognizes. Here's the part most people miss. Institutions already know where the pressure points are because they live inside the system. They watch inventory classifications, they watch delivery notices, they watch lease markets and regional premiums. The public sees a spot price and assumes that price is the truth. But the spot price is often a compromise between paper convenience and physical reality, and when that compromise starts to fracture, the signals get loud. And what I'm about to lay out changes how you interpret every silver headline you'll read this year, because this is not opinion. This is pattern. Welcome to Vault Signal, where we decode what matters before its headlines. If you've ever wondered why the market feels calm on your screen while the real world feels tight, you're in the right place. If this kind of deep dive connects dots you hadn't seen, stick around and tell me in the comments where you're watching from, because premiums and delays can look completely different depending on your region and your preferred products. Now let's get forensic about what actually happened. Start with the dates, 3% from the month before. That sounds like a mountain of metal. But at the same time, the market is sending a conflicting message, the marginal ounce. The ounce that can be sourced quickly in the form required at the right location is getting harder to obtain without paying up. Then you look at the COMEX layer, 483 ounces across eligible and registered categories, nearly 400 million ounces. 854 ounces are in the registered category. The bucket tagged as deliverable against futures. 629 ounces is eligible, which means it meets exchange specifications but is not committed for delivery unless the owner chooses to convert it. And here's the central mystery. If the price is supposedly the same for everyone, why would anyone pay a premium for physical right now? Why would delivery timelines stretch? Why would certain products vanish while paper contracts trade like nothing is wrong? This is the crisis unveiled in one sentence. The price is a single number, but the market is a network of constraints. Constraints like fabrication, constraints like shipping, constraints like refinery throughput, constraints like the form factor required by mints, industrial users, and exchange warehouses. Constraints like geography, because an ounce in the wrong place is not the same as an ounce in the right place. And constraints like classification, because an ounce labeled eligible is not automatically available to fulfill delivery obligations. So when people say there's plenty of silver, they may be talking about the wrong pile, the wrong form, the wrong location, or the wrong timeline. The physical tightness narrative becomes even more compelling when you zoom out to the regional dislocation. In early 2026, reports described Shanghai prices trading more than $14 above London benchmarks. Over $14. That kind of spread doesn't exist for fun. It exists because the system is struggling to move metal from where it sits to where it is needed, in the time frame that buyers demand, at a cost that makes arbitrage easy. When that movement becomes difficult, the spread becomes a signal. Now overlay the institutional layer, $5 billion. That number matters for two reasons. First, it tells you the scale of institutional participation. Second, it hints at a market where volatility is not a surprise. Volatility is where risk is transferred and where profit and loss is concentrated. Because when physical markets are tight and regional pricing gaps expand, someone is carrying risk. A producer hedges output, a manufacturer hedges input costs. A trading house tries to capture spreads. A fund takes a directional view. And when positioning becomes large relative to available liquidity, it can push the system into abrupt repricing, not through a slow drift, but through sharp adjustments when constraints become undeniable. Now let's talk about mint demand, because that's where the average person feels shortages first. In June 2025, the U.S. Mint released a 2025 W-proof silver eagle with a U.S. Army privy mark with a mintage of 100,000 coins. It sold out on launch day, June 13th, 2025. That's not an abstract statistic. That's a real demand shock. It shows how quickly retail appetite can absorb a fixed supply of fabricated silver products. And it also shows something subtle. Mints do not scale output instantly. They plan schedules, they allocate capacity, and they work within constraints that don't change just because demand suddenly spikes. That's the mechanism behind so many shortage stories. The raw metal might exist somewhere, but the product people want, coins, small bars, minted rounds, requires fabrication capacity. Fabrication is the bottleneck that turns a supply story into a delivery story. And delivery stories are what capture attention because they show up in everyday experiences. Orders delayed, back orders opened, premiums widened, and inventory lists that shrink overnight. Here's where it gets interesting. This mint demand meets delivery delays storyline is not new. It has a historical fingerprint. And when you study that fingerprint, you start to see why the market behaves this way and why the contradictions don't resolve smoothly. In 2008, the global financial crisis drove a wave of demand for tangible assets at the exact moment liquidity was collapsing. Silver's price moved violently, but the more revealing story was what happened to coins and small bars. Premiums widened. Dealers ran out of popular products. Delivery times stretched. The public saw price falling and assumed demand was gone. But physical demand was surging, and the bottleneck was fabrication and distribution. Result, the paper price and physical availability told different stories at the same time. In 2011, silver ran toward $50 an ounce in a dramatic move that ended with a sharp reversal. The pattern was similar. As price rose, retail demand surged. As volatility increased, exchanges adjusted margin requirements, which forced leveraged participants to reduce positions. That created selling pressure in paper markets even as physical markets stayed tight. Result, the price dropped fast, but premiums remained elevated for many products because the supply chain couldn't instantly refill shelves. In 2020, the pandemic created a logistical shock. Refineries slowed, shipping routes snarled, and demand patterns shifted abruptly. Physical silver premiums exploded in many places. Futures markets saw their own dislocations around deliverable forms and location. Result, a visible gap opened between the quoted spot price and the price people actually paid for physical products. The market didn't run out of silver in a geological sense. It ran into friction, and friction is what tightness looks like before it becomes a price event. Now in 2026, you can see the same ingredients assembling again. Deliverable classifications matter. Regional spreads matter. Mint demand spikes matter. Institutional positioning matters. And the most telling sign is not a single headline. It's the contradiction between what different layers of the market are saying at the same time. So who are the players, and what are they doing? First, you have the exchanges, CME Group's COMEX in the West and the Shanghai Futures Exchange in China. Exchanges provide the framework for trading and delivery, including contract specifications, warehouse networks, and margin rules. They are the stage, but they also influence the script because margin requirements determine how much leverage participants can carry, and leverage determines how quickly positions are forced to change when volatility rises. Second, you have the vault networks and reporting bodies. In London, the LBMA vault reporting gives a snapshot of how much metal sits in the system. In the COMEX ecosystem, warehouse reports break holdings into eligible and registered categories. Those categories are not trivia. They are the difference between metal exists and metal is offered to settle obligations, and in tight markets, that distinction becomes everything. Third, you have the industrial layer. Silver is not just a monetary metal, it's an industrial input. That means demand is not purely investment sentiment. It's also manufacturing schedules, long-term contracts, and the steady pull of industries that cannot easily substitute away from silver in the short term. When industrial demand remains firm while investment demand surges, the system tightens faster than price alone suggests, because the same inventory pool is being asked to satisfy two different kinds of demand on two different timelines. Fourth, you have the mints and fabricators. They take raw silver and turn it into products people can buy. They are where supply meets retail emotion. When they are backlogged, the public feels it immediately, even if the spot price looks quiet. That's why delivery delays are so powerful as a signal. They are a real-time indicator that the front end of the supply chain is saturated. Fifth, you have the institutional traders, banks, funds, and brokers that provide liquidity and carry positions. Shanghai Futures is one example in the Chinese market, with a reported short equivalent to 484 tons as of February 2nd, 2026. In the Western market, different institutions take different sides depending on their role. Hedging, market making, or speculation. What matters is not whether a position is long or short. What matters is how positioning interacts with delivery constraints and how quickly it can change under stress. Because in a tight physical market, paper positions can become a problem. Not because delivery must occur on every contract, but because the system relies on confidence that delivery could occur if demanded. That's a subtle but crucial distinction. Futures markets function because most contracts are offset before delivery, but the credibility of the contract is anchored in the ability to deliver. When confidence in that ability erodes, even slightly, the market starts to price risk differently, and liquidity can vanish faster than people expect. Now let's zoom into the dislocation itself, because this is the part no one is discussing with enough precision. Dislocation is when two markets that should be connected start behaving like separate worlds. On one side, you have the paper market, futures contracts that trade with immense volume and tight spreads. In that world, liquidity is abundant, and the price is a clean number on a screen. On the other side, you have the physical market, metal that must be fabricated, shipped, insured, and delivered in specific forms. In that world, time matters, location matters, and the spread between available now and available later can become the real price. The COMEX warehouse report gives you a measurable way to see this. 483 ounces looks reassuring. 854 ounces. That means roughly 26% of total COMEX warehouse silver is in the deliverable bucket, while roughly 74% is eligible, owned by someone, stored under exchange rules, but not pledged for delivery. That ratio can change, and it often does. But when the registered pile shrinks relative to delivery demand, stress increases, because deliverability is a promise the system must be able to honor. Now pair that with the Shanghai premium signal. A spread of more than $14 above London is not a rounding error. If London and Shanghai were perfectly connected by frictionless arbitrage, that gap would be quickly closed by moving metal. But moving metal takes time. It takes approvals. It takes financing. It takes logistics. And sometimes it requires bars of a certain spec, sourced through a chain of refineries and warehouses that cannot be rerouted overnight. The result is a persistent gap that tells you immediacy is being priced separately from the headline benchmark. This gap cannot persist indefinitely without consequences. Either the physical premium collapses because supply floods in, or the broader price structure adjusts upward to reflect the true scarcity of deliverable, available metal. Historically, when these gaps emerge, they resolve through repricing, not through polite convergence. Now, let's lay out the evidence with numbers, because numbers are where narratives become testable. 854 ounces. That is deliverable inventory, and it is the most direct proxy we have for immediate settlement capacity within that system. 629 ounces. That metal exists, but it is not committed. It can become registered, but only if owners choose to make it deliverable. That choice depends on incentives. If owners believe holding metal is more valuable than offering it for delivery at a given price, they keep it eligible. If they believe premiums elsewhere are more attractive, they may withdraw, sell, or reclassify. If they believe counterparty risk is rising, they may prefer the option of control over the obligation of delivery. 3% month over month. Again, a large pile in absolute terms, but a direction that matters. In tight markets, direction matters more than size. A shrinking pile suggests net outflow, increased draw, or reallocation. And when a draw coincides with widening regional premiums, it suggests the system is feeding demand elsewhere, even if the benchmark price looks calm. $5 billion, reported as of February the Koken 26. That tells you there is serious leverage and serious exposure inside the system, which can amplify moves when volatility hits, because large positions must be managed, financed, and adjusted under stress. Evidence point 5 is the retail demand shock illustrated by that 100,000 coin proof Silver Eagle sellout on June 13, 2025. When retail demand activates, it often does so in bursts. It doesn't politely scale. It floods the front end of the supply chain and creates backlogs that take time to unwind, especially when fabrication capacity is finite. Now connect those points. The deliverable category is not massive. The eligible category is large but optional. London stocks are large but trending down. Shanghai is signaling scarcity via premium. Retail demand can surge into limited fabrication capacity. Put together, this is a classic setup for delivery delays in a tightening narrative that spreads faster than price charts can explain. So what does this mean? And what is the mechanism that creates these outcomes? Think of the silver market like a highway system. Paper trading is a wide, fast freeway. You can change lanes quickly. You can enter and exit with minimal friction. Physical metal is the network of bridges, toll booths, and loading docks that sit underneath. It has weight. It has constraints. And when a surge of traffic hits, the freeway might still look clear on a dashboard, but the bridges and toll booths start backing up. Delivery delays are the traffic jam you can't hide. In volatile moments, exchanges can raise margin requirements. That forces leverage participants to post more collateral or reduce positions. When positions are reduced quickly, selling can appear even if physical demand is strong. That's why the paper price can fall while premiums stay high. The paper layer is reacting to leverage. The physical layer is reacting to availability. At the same time, owners of eligible inventory make choices. If they perceive scarcity, they may hold rather than convert to registered. If they perceive better premiums elsewhere, they may ship metal out of the exchange system. And if they perceive rising uncertainty, they may prefer control over deliverability. Those micro decisions aggregate into macro outcomes. Registered inventory tightens, delivery stress rises, and the gap between quoted price and real purchase price widens. Now, forward analysis. Historically, when premiums and deliverable inventory tell opposite stories, the market is being forced to choose which price is real, paper convenience or physical immediacy. And historically, one of three pathways tends to emerge. In a conservative pathway, the system adapts. Fabricators catch up. Supply flows toward the highest premiums, regional spreads narrow. Registered inventory stabilizes. The benchmark price may move, but it doesn't need to explode for the stress to ease. The key signal in that world is normalization of delivery timelines and a visible compression of premiums. In a moderate pathway, the benchmark reprices to reduce the incentive for regional dislocation. If Shanghai continues to pay far above London, and if deliverable inventories remain constrained, the global price structure tends to rise to reflect the cost of moving and sourcing metal. The premium becomes embedded in the benchmark over time, not because of drama, but because economics demands convergence. In an aggressive pathway, the system encounters a shock while it is already tight. That shock can be volatility, policy change, a sudden inventory draw, or a wave of demand that hits the same bottlenecks simultaneously. In that world, the sequence is often violent. Paper selling driven by leverage, followed by physical repricing driven by scarcity. The screen looks chaotic, but the plumbing explains it. So, what should you watch in the days and weeks ahead if you want to understand which pathway is unfolding? Watch the registered number and how it changes relative to eligible. 854 ounces or slides lower. Watch whether eligible falls as metal leaves the system, or whether it remains stable while registered tightens. Watch London's month-to-month vault trend after end, January 2026's 27.7729 ton figure. Watch whether regional premiums like the reported Shanghai spread remain extreme or begin to compress. Watch delivery notices and settlement behavior. Watch whether product availability improves at the retail level or whether delays become normal. And watch the language. When dealers shift from in stock to pre-order, the market is telling you something about time. Now we arrive at the choice ahead, and this is the dividing line between people who see the surface and people who see the system. Most people follow price alone. They see a line on a chart and assume that line is the entire market, but price is the surface. The plumbing is underneath, and when the plumbing tightens, the surface can look calm right up until it suddenly isn't. This is not about being smarter. It's about paying attention to the right layer. The information gap becomes a wealth gap because institutions move first. They see inventory changes early. They see delivery stress early. They see regional premiums early. Retail tends to react last, after the story is everywhere, after premiums are already wide, after delivery delays become normalized. And that's why this moment matters. Not because it guarantees anything, but because it reveals the structure. It reveals that silver is not one market. It's multiple markets stitched together by logistics, incentives, and trust. When those stitches pull tight, the tension shows up in the seams, mints, vault classifications, and regional spreads. This is Vault Signal, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. And remember, the question isn't whether this unfolds. The data already shows stress. The question is whether you'll recognize the pattern before everyone else starts calling it a surprise.